Hi guys, this video is the fourth in our series looking at banks and monetary policy, and in this video we're going to apply what we've looked at with the financial system, with money and with banks to think about how the Bank of England goes about regulating the monetary system in order to achieve its objectives. We're going to be looking at four monetary policy tools as well as overviewing how this works, and then in the next chunk we'll be looking at financial regulation. I've split this video into two sections because there's quite a lot going on here, and do use the timestamps in the video description to navigate through the different chunks we're going to be looking at. So we're going to start by overviewing monetary policy before zooming into this video into the base rate of interest as probably the main monetary policy tool that the Bank of England uses. So monetary policy overall is managed by the Bank of England. And as we've seen, there's a number of things it involves directly monitoring or changing. The Bank of England has the ability to monitor and change interest rates, the supply of money, and they monitor the exchange rate. And this is kind of our big three areas that traditional monetary policy is focused on, but we're going to see that modern monetary policy has a slightly different emphasis. The Bank of England's objectives, this is verbatim from their website, are as follows. They're aiming to deliver price stability, so low inflation, and we know that that's a 2% inflation target. And subject to that, so there's a secondary objective, to support the government's economic objectives, including those of growth and employment. So primarily they're targeting 2% inflation, but if they manage to achieve that, they're also looking to support the government. That's monetary policy in a nutshell. That's what we're trying to do. What we're going to do for the rest of this video is look at the different policy instruments, the different options the Bank of England has to achieve those aims. And the first one we're going to look at is the base rate of interest. We're going to spend the rest of this video looking at that. The base rate of interest is the rate of interest that banks receive on the credit they hold at the Bank of England. The rate of interest that banks receive on the credit they hold at the Bank of England. That's a really important definition, because often in economics we just talk about the interest rate, but there isn't one interest rate. If you were to go and borrow from a payday loan company, a really short-term loan, the interest rate you pay might be 30-40%. If you go and save your money in a deposit account, you're probably going to receive 0% at the moment. There's lots of different interest rates in the economy, but they're all influenced by this base rate of interest. And they're influenced, and the whole economy is influenced, through something called the monetary transmission mechanism. And so this section, we're going to zoom in on how interest rates affect the macroeconomy, because it's no longer going to be quite detailed enough just to say that interest rates affect consumption and investment, thus affecting aggregate demand, as we've seen. When we're dealing with monetary policy, we want to be aware that there's a little bit more going on than that. We want to know why it affects those things. Just for some context, here is the base rate of interest in the UK from 1999 up to the present day. And you can see that in the 90s and early 2000s, it was quite high, around 5%. It's actually been a lot higher than that historically. When the 2008 financial crisis hit, it plummeted from 5.5% down to 0.5%. There was a little bit of movement. It dropped to 0.25, then rose to 0.75, where it had been for the last few months. But then in response to the coronavirus crisis, it plummeted to 0.1%, the lowest the base rate of interest has ever been. Now we need to be aware of how that changes in that bank rate or base rate of interest end up actually affecting inflation. And remember, that's the main reason that it's being used. And it's quite a complex process, but I'll boil it down for you and hopefully it'll be fairly straightforward. We might need to condense what's going to come up on the screen into a 15-mark question. I'll show you that type of question in a moment. So it's worth taking some notes beyond just the boxes so that you can explain to yourself and to the examiner what's going on with this transmission mechanism. There's four initial channels by which the bank rate affects the macroeconomy. The first is market rates. Changing the bank rate will affect market rates. By market rates, we mean all those other rates of interest that we spoke about a moment ago. And that's because the bank rate, the base rate, is the amount of interest earned by banks on reserves held at the Bank of England. So it affects how much money banks have to lend. They can offer higher interest rates on savings if the base rate is higher, and they'll also charge more for borrowing for the same reason. And that's going to have a variety of effects, not least on asset prices. If the interest rate on one financial instrument, say saving, go up, that means there's going to be more demand for saving, less demand for other financial assets. And as we've seen with bonds, when the price of an asset goes down and the interest rate goes up. So if the base rate were to rise, asset prices would go down. And if the base rate were to fall, asset prices would go up because there's less demand, more demand for assets if the base rate is lower. So if the base rate falls, market rates will fall, asset prices will rise because there's more demand for other assets. Expectations and confidence will also be affected because if the Bank of England makes a substantial change to the base rate, it's going to impact people's confidence. When the Bank of England dropped the base rate in response to COVID-19, that had a positive impact on confidence and expectations because the market saw that the bank was responding appropriately. Lastly, the base rate will affect the exchange rate. And I'll run you through in a moment how this works in a little bit more detail. But this overlaps with a topic we're going to be doing down the line, where we look at the determinants of the exchange rate. So I'm not going to worry too much about that for now. We just need to know that the exchange rate is going to do the same thing as the base rate. If the base rate drops, the exchange rate is going to drop. Okay, now all of these are going to affect domestic demand. If market rates go down, that means there's going to be more borrowing and less saving, which means there's going to be more spending, more investment. If asset prices drop, we're going to get the wealth effect happening. So if asset prices drop, people feel less wealthy, so they will spend less. If expectations and confidence improve, we're going to get more spending. If the exchange rate drops, we get more. That improves our net trade, and we're going to get more consumption on domestic goods and more exports. Make sure you're happy with those different channels. I'll just run through them once more. So if the base rate drops, market rates drop, so we get less saving, more borrowing, so more consumption investment. If the base rate drops, asset prices will rise, causing the wealth effect to kick in more, causing more demand. If the base rate drops, expectations are probably going to improve, causing more consumption investment as well. And the exchange rate will drop if the base rate drops, causing less consumption on imports, and so more consumption on domestic goods and more exports. So we're going to get an impact on domestic demand and net external demand. That is the demand for our exports minus the demand, UK's demand for imports. Overall, we're going to get an increase in aggregate demand. And we've spoken about that in previous topics, but we've now just added a bit more detail into why aggregate demand increases when the base rate falls. That's going to cause demand pull inflation, domestic inflationary pressure. As an aside, this is a very minor effect. The drop in the exchange rate also makes imports more expensive. And so it's going to generate a bit of pressure on import prices, causing some cost push inflation. By far the major effect is the demand pull domestic inflationary pressure. A little bit of cost push as well, both of which cause some inflation. So here's the key idea: when the base rate falls, inflation increases. And that's because a fall in the base rate pushes down market rates, pushes up asset prices, pushes up expectations and confidence, and it pushes down the exchange rate. Lots going on there. You might want to watch back over what we just discussed. All of it is based upon content that we already know. So you should be happy with the impact of the base rate on asset prices, the impact of market rates on demand, the impact of expectation and confidence, and the impact of the exchange rate on demand. But lots going on, so do have a look back over it if you're at all unsure. Let's just see a bit of context. Inflation management that we've been speaking about is a demand side policy. It's primarily affecting aggregate demand. It's not supply side. Monetary policy is all demand side. We can get caught out by that because sometimes we talk about the money supply, but no, this is all demand side stuff. Bit of context: the Bank of England reckons that a change in the base rate takes 2 years to have its full impact on inflation. And they reckon that a 1% change in the base rate, or 1 percentage point change in the base rate, affects output by about 0.2 to 0.4% after 2 years. And those are two really nice little statistics about the time lag and the magnitude of changes in the base rate. Now, the base rate is set by something called the Monetary Policy Committee, and we need to be happy with these guys. This is a really good point to look at some context. You might want to go and look at the Bank of England's website. They've got loads of information on how the Monetary Policy Committee works. It's made up of 9 members, some from the Bank of England and some independent members representing different areas of industry. They'll normally meet about 8 times a year, and they consider a whole range of economic indicators, and they're trying to predict future inflation 2 years down the line in order to set the base rate now. They do meet more than that if there's an emergency. So in the COVID-19 crisis, they had a number of emergency meetings to work out how to respond to the crisis. We need to be really familiar with the Bank of England's Monetary Policy Committee. They're the key group that sets monetary policy. We also need to be happy with how the base rate of interest is going to affect our other objectives. Its primary impact is on inflation. But let's just see some of the detail of how it affects everything else. So what I'd like you to do is just pause the video, look through these, and hopefully it'll be quite clear how make sure you're happy with how a fall in the base rate is going to affect each of these objectives. Okay, well, we see most of these already. A fall in the base rate is going to increase economic activity, as we've seen. So we're going to get less unemployment because there's going to be more economic activity, and for the same logic, more short-run growth. Not necessarily more long-run growth. Remember, this isn't a supply-side policy. We're going to see more tax revenue because more people are going to be earning money, which can be taxed, and fewer people are going to be unemployed. And as we've seen, we'll get a fall in the exchange rate. Let me give you a little bit of explanation on why the exchange rate falls when the interest rate falls. And again, we're going to look at this in more detail because one of our topics coming up is just on how exchange rates work. But let me run you through the logic briefly. The key idea is that one of the big impacts on the exchange rate is money moving between countries. It's called hot money, and it's money saved by really big firms. And the key idea is that these firms are really only interested in guaranteed returns. So they just want to save their money where interest rates are higher. So if interest rates rise in the UK, that means saving money in the UK looks more attractive. Money therefore will move into the UK from other countries. And in order to do that, the people moving money have to sell whatever currency they're keeping the money in and buy pound sterling. And if they're going to buy sterling, that creates more demand for sterling, which pushes the exchange rate up. Whereas when interest rates fall, the opposite happens. Money moves out of the UK, so lots of sterling is sold, decreasing the exchange rate, pushing down the price, and the exchange rate therefore falls. And the key idea here is just realizing that the exchange rate is a price with demand and supply, just like anything else. But don't worry at all if you're not sure about that because we're going to look at this in a lot of detail when we look at the exchange rate topic down the line. Now we need to be able to evaluate it, the interest rate, base rate management. And here's a question that we might have to answer. It's discuss the significance of the interest rate in achieving the government's macroeconomic objectives. Now, to answer this question, we obviously need to know why the interest rate might not be a perfect tool. We'll talk a little bit more shortly about how we might tackle a question like this overall. But one thing we're going to need to be able to do is discuss the drawbacks of managing the economy using the base rate of interest. And there's 4 issues I reckon we could talk about. The first are the time lags we've mentioned. Remember, 2 years to have its full effect. So it takes ages, and therefore it depends upon forecasting, economic forecasting. It's really difficult to forecast what's going to happen in the future. We can't forecast economic shocks like COVID-19. The base rate of interest also has quite uncertain effects on the economy. We don't know quite how much of an effect it's going to have on some of our other objectives. And although the Bank of England is primarily targeting inflation, it's hard to work out what other things it's going to have to do, and we are concerned with that. Bank of England also has to consider how it's going to affect confidence now. It could be that dropping the base rate of interest might actually worsen confidence if it means that the markets realise that the crisis that the bank's responding to is worse than was previously thought. The Bank of England always has to consider the effects of a change in the base rate on market confidence, market expectations. And lastly, and we'll look at this more shortly in the next video, there's the issue of the zero lower bound, and this is the idea that the base rate of interest can't be dropped below zero. There comes a functional limit to how low we can drop interest rates. You might want to look up negative interest rates. Some central banks have offered negative base rates, but market rates can't drop below zero. And the problem is if base rates get too close to zero, they start becoming really ineffective. And so there's a trade-off with dropping the base rate. It's going to have an impact, but it also risks causing the base rate to become ineffective as a policy tool. Lastly, let's just have a quick look at some exam questions. There's two major ways that this could come up. We may well get a 15 marker on this transmission mechanism. So we'd have to explain how a change in the base rate of interest affects inflation. And what we're going to do there is, remember we've got those four channels, market rates, asset prices, confidence, and the exchange rate. Our rule of thumb with 15 markers is 2 points. So we're probably just going to want to group those four channels into 2 points, so have two in each paragraph, and just discuss how they're going to impact. Make sure you use at least one aggregate demand, aggregate supply diagram to support your explanation. But we might also have to deal with this kind of 25 marker, and whenever we've got a question like this, we want to spot the key word, and the key word here is significance. That is the question. That is the word that helps us work out where our answer is going to go. We're going to need to have two sides to this argument. On the one hand, yes, it's significant. On the other hand, it's not significant. And the best way to argue that it's not significant, arguing that it is significant, is straightforward, right? Because we just need to explain why base rates are important. So we're just really explaining the transmission mechanism and the role of the base rate, which should be quite straightforward. On the other hand, though, we need to explain why it isn't significant. And it's hard to just talk about the downsides here, though we could do that. It's easier to focus on why other policy tools might be better. So, for example, we could talk about when the interest rate is ineffective, when we're recovering from a recession, we might use something like quantitative easing, and that's more significant. We'll come back to questions like this once we've looked at a few more tools and see how we could go about doing this. So we looked in detail at the base rate of interest. Next up is money supply management, which we'll look at in the next video. But by the end of this chunk, you should be familiar with how the base rate of interest affects the macroeconomy, how the Bank of England set the base rate of interest, how it impacts its objectives, and some of the downsides with using the base rate of interest as a tool to manage the macroeconomy. It is the main tool that is used. It's the one that's most constantly adjusted, but it's not the only tool, as we'll see in the next chunk.